สวัสดีค่ะท่านผู้มีเกียรติทุกท่านนะคะขอต้อนรับทุกท่านเข้าสู่หลักสูตรอบรม Startup Valuation Workshop ค่ะซึ่งหลักสูตรนี้นะคะเป็นส่วนหนึ่งของหลักสูตร Common Issue in Early Stage Fundraising โครงการการอบรมภายใต้ความร่วมมือระหว่างตลาดหลักทรัพย์แห่งประเทศไทยโดยห้องเรียนผู้ประกอบการและ Expara ประเทศไทยภายใต้โครงการการรับมือและฟื้นฟูธุรกิจอย่างเร่งด่วนโครงการสนับสนุนผู้ประกอบการระดับโลกนะคะที่ดำเนินการโดย Use Business International ด้วยการสนับสนุนจาก google.org ค่ะสำหรับเวิร์กช็อปในวันนี้นะคะจัดขึ้นตามคำเรียกร้องของผู้เข้าร่วมสัมมนาและผู้ประกอบการทุกท่านนะคะจะพบกันทั้งสิ้น4ครั้งค่ะสำหรับในวันนี้นะคะทางคุณดักลาสค่ะจะใช้เวลาประมาณ1ชั่วโมงนะคะให้ภาพรวมเกี่ยวกับเรื่องของการประเมินมูลค่าธุรกิจสตาร์ทอัพนะคะหรือว่าบริษัทธุรกิจระยะเริ่มต้น Please meet Douglas Abram, founder and CEO of Expara.
Good evening. Thank you, Nan, for the introduction, and thanks participants for joining us in the first session of our 4-session Startup Valuation Workshop. I'd like to just give a special thanks to our partners in the Rapid Response Program. Topics that we're going to cover tonight. I'm going to talk about how to VCs, meaning venture capital investors, make money. What are the traditional valuation methods that we use for valuing companies, and why did most of them fail when we try to apply them to startups? What are the 3 valuation methods that we can use for startups? Why startups need to own their own financial model, and building your own revenue projection-based valuation model. So those of you who have attended some previous workshops or talks of mine, you might have heard some of these topics. So I'll go through the introductory slides relatively quickly, but I want to review this material for those that have already learned it and make sure that those who don't know have an introduction, because this is a very important context for valuation. VC investors can make money one of 2 ways. Through a trade sale, where the company they invest in is sold to another company, or through an IPO, where the company they invest in is sold to the public through listing on an exchange like Stock Exchange of Thailand in the Thai startup and VC market. What this means is for venture capital investors, if there's no exit, there's no return in their investment. So what determines the return on investment for venture capital investors? There's only 2 numbers that determine venture capital investors' ROI, return on investment: exit valuation and current valuation. So we can do a very rough calculation of a projected ROI in a venture capital investment by just dividing the exit valuation by the current valuation. Now, of course, later, we're going to go over this in more detail, and we'll see that we need to adjust that number for dilution. But conceptually, the only 2 numbers that determine the VC's ROI are the valuation at which they invest today and the exit valuation. The exit valuation is essentially fixed by the market, meaning the VC can't really negotiate the exit valuation. The market will set the exit valuation either through the price that acquirer is willing to pay or the value that the company can list at. Therefore, we're left with only 1 number. So the current valuation basically determines the VC's ROI. Current valuation meaning the valuation at which the investment will take place. And that's why we need to make sure that valuation works for both the startup and the investor, because if an investor invests at the wrong valuation, they will not earn their required return on investment. And of course, if the startup invests at the wrong valuation, this can have serious negative consequences for the startup. Now, those of you who know me know I strongly prefer trade sale exits. Of course, if we can list on SET, that's great. And I believe that we will see in Thailand many more startups than have historically been able to list in exits, do IPO listings over the next 5 to 10 years. But it remains a fact that even in the US market, which is the most active venture capital market in the world, 90% of venture funded exits are trade sales. So trade sales are the bread and butter exit of venture capital invested startups, just because there are many, many more trade sales every year than there are IPOs. And if you don't know what trade sale means, or if that's not clear, trade sale is the other side of an M&A. When a larger company buys a smaller company, that's usually called an M&A or merger and acquisition. From the acquiring company's perspective, from the selling company's perspective, that's a trade sale. And if we look again at some historical numbers from U.S. Venture capital markets, we see the median valuation of an acquisition is $100 million US. I want everybody to remember that number, around $100 million US, because this will become a pretty important number when we talk about the current valuation. Remember, current valuation and exit valuation are highly positively correlated. So if we keep in mind that an average successful venture capital trade sale exit should be somewhere in the range of US $100 million, 3 billion Thai baht, that'll give us a good basis for thinking about what are reasonable range of valuations at different stages of venture capital investment. Again, looking at all exits, so when we look across IPOs and trade sales, we see median for all exits at 161 million. So adding that to our previous number, we can see expect average exit for venture funded startups to be somewhere in the range of 100 to 160 million US dollars. Now, our goal is to value our startup so that it is attractive for both the startup management team and founders and investors in the startup. So startup is just a different type of company. I mean, a startup is still a company. We have many well-established methods for valuing companies. So why do we struggle so much with startup valuation versus company valuation? Now, of course, company valuation itself is difficult because there are different ways to value companies, and different people will have different views of valuation of the same company. But we're in even a more difficult situation when we try to value a startup, because many of the well-established methods of valuing companies are not applicable, or not easily or readily applicable to valuing startups. Why is that? Because traditional company valuation methods were developed basically to value publicly traded companies. And when these traditional methods look at the value of a company, they assume that the company will create value for its shareholders through two channels. One is capital appreciation, and the other is dividends. So if you look at traditional valuation methods, they will typically balance the value created for shareholders through capital appreciation and dividends and arrive at a value of the company that way. But this is not how startups create value for their VC shareholders prior to exit. So this is the root of the problem in valuing startup companies. I think a lot of people think the most difficult problem in valuing startup companies is lack of historical data, but I actually don't think that's the biggest problem. This is definitely another challenge, but I don't think that is a fundamental issue, because we don't necessarily need that much detailed historical data to come up with reasonable valuations for companies, because the vast majority of company valuation methods are forward-looking anyway. They're not based on historical data, and we're projecting data. So the fundamental problem is the different way that startups create value for their shareholders. They create value for their shareholders by maximizing capital appreciation and then engaging in a trade sale or an IPO. And if you're an investor looking at the startup today, you need a valuation that takes account of that method of shareholder value creation. If your method of valuation does not take account of that method of shareholder value creation, the value will not be correct. And That's the fundamental problem that we have. So these are when I talk about traditional valuation methods, they're basically the first 5 methods on this list. So you probably have heard of these: price to earnings valuation method, dividend yield, multiple of book value. So the first 3 of these valuation methods, my view is they cannot be applied to startups at all, because price to earnings valuation focuses on earnings. High growth startups don't focus on maximizing earnings in the early years, especially. And why is that? Because they're trying to grow as big as possible, as fast as possible, so they get maximum value at the, especially trade sale exit, where they're almost always valued on revenue, not on earnings. And startups don't pay dividends. So the dividend yield method evaluation is not going to be applicable at all. If you want to learn more about why startups don't pay dividends, there's an article on this topic in the online course. Multiple of book value. This is not a forward-looking valuation method, and therefore it's not going to be applicable to startups whose current book value is going to be an infinitesimal fraction of their ultimate firm value. So we're left with 3 valuation methods that can be used for startups. 2 can also be used with other companies, or are typically also used with other companies: comparables valuation and discounted cash flow valuation. Now, there are a couple of challenges there. We're going to cover comparables valuation and discounted cash flow valuation in the next lesson, which is going to be on 2 days from now. So I won't spend a lot of time on comparables and discounted cash flow today. I'll talk also about what are the challenges we face in applying those methods. But these are 2 traditional company valuation methods that we will be able to apply to startups. What we're going to focus on in this course is how we need to adjust these in order to make them applicable for startups. So I see a lot of entrepreneurs apply or try to apply comparables and discounted cash flow valuation to their startup, which it's not wrong, but they miss some key adjustments that need to be made in these methods, which we will study in detail in tomorrow's course. And the last method of valuing startups, which those of you who've seen my previous course know is my favorite approach. It's called VC method. VC method stands for venture capital method. So it makes sense that this would be a method that is widely applied by venture capital investors to startup companies. We will learn more about venture capital method of valuing startups in the 3rd class, which is going to be a week from, it's going to be next week on Tuesday. So we'll study the venture capital method in detail in class number 3. So one point that I wanted to bring up at an early stage of our workshop, we're going to spend a lot of time in our program going through our financial model. And we're going to be using the financial model that Expara uses to value companies that we invest in, and that I use in all of my classes with students that are learning valuation. So it's a real functional valuation model. And when I deal with some entrepreneurs, and especially first-time entrepreneurs, they always, it makes sense that, and it is correct that most entrepreneurs come from the product side. They don't come from the finance side. Occasionally we see entrepreneurs coming from the finance side, but vast majority of founding teams come from the product side, and that's as it should be. But startup companies must have 2 strategies. They have a strategy we call product market fit, which is developing a product and identifying the market that needs that product and making sure that there is a strong need for the product in that market, and then letting that market know about it, and then entering that market and then owning it. So I think most of us are familiar with that strategy. But successful, scalable startups also need to have a strong financing strategy. And the strong financing strategy is as important as the product strategy, because you can have, if you have great product market fit, but you don't have an effective financing strategy, you're going to fail. And I see a lot of way too many startups in that situation where they have potential to succeed, but they don't have a sound financing strategy and they don't make it. And this is tragic, because I think very sad, because if your startup is going to fail, it should fail because you don't get product market fit right. I mean, it's not bad to fail as a startup. Depending on how we define failure, I usually will estimate that between 50 and 75% of venture funded startups will fail. So no shame in that. It's okay to fail. But you should fail because you couldn't get the product market fit right. You shouldn't fail because you have a poor financing strategy, because financing strategy is much more straightforward and possible to execute perfectly or close to perfectly every time than product market fit strategy, because there's a lot more competition on product market fit side. So I'll make the point here, both are equally important for your startup success. And just as management, founding management team, I don't think founding management team is ever going to outsource their product market fit, because that's the core of a successful startup. By the same token, the founding management team should not be outsourcing their financing strategy. So I talked to some startups, especially first-time startup CEOs, and I ask about the financial plan or financial model, and they'll say, oh, we have accounting, our accountant is doing that, or our financial advisor is doing that. It can't be like that. The CEO or CFO of the startup must lead the startup's financing strategy. They must have a deep understanding of the company's financing strategy and financial model. Accountants don't do financing strategy for you. They do your bookkeeping and accounting for you. And a financial advisor who's not in your management team is not the right person to be managing your financial model. So as the company grows, you might hire financial advisors for certain specialized tasks. But even then, the management team needs to deeply understand the company's financial model and the company's financing strategy. So if you were thinking about outsourcing that, definitely don't do it. If you have already outsourced it, I would try to bring it back in-house ASAP. So what does a financial model look like? Financial model of your financing strategy should consist of, I think, what I like to see is 3 to 5 years, and usually for me 5 years of projected financial statements. So balance sheet, income statement, and cash flow statement. This is called pro forma financial statements. Pro forma financial statements mean financial statements that are not based on real historical results, not built from real transactions, but are created by a forward-looking financial model. So we have a financial model that we put a series of inputs into, and this financial model will create a set of financial statements for the company in the future, meaning forward-looking financial statements. And this is a very difficult task if you think about it. What we try to do in the financial model is we're going to attempt to describe the company in numbers, where most of the time we're very used to describing the company in words. So we have a investor pitch, we have PowerPoint deck, we have a business plan. We're able to describe probably very clearly in words what our business is about. And that's great. We have to be able to do that. The next thing that we need to be able to do to be a successful management team, and also, of course, to be a successful investor in startup companies, is to be able to describe the company in numbers, and that's what the financial model does. We translate the company into a financial model of the company. I like to point out that the difference between a model of something and the thing that's being modeled is the level of complexity. So the process of financial modeling, or the process of modeling anything, and specifically financial modeling, is a reduction in complexity, or we can say simplification. So our financial model won't describe every aspect of the company in numbers. That would be impossible. So in order to get a meaningful but manageable financial model, we need to describe pick the key financial elements of the company so that we can extract those elements into our financial model and arrive at a meaningful financial description of the company, and also meaningful valuation, which is going to be the output of our financial model. So how are we going to do that? The basis of the vast majority of financial models, including the one that we're going to do in class, is our revenue. So when we create a financial model of a company, especially financial projection, we're going to begin the financial projection by projecting our revenues. Why do we do that? Because typically everything else about the company's financials are related to the revenue. Now, this is not true of a few types of companies. So there are a few types of companies that don't generate revenue, like drug development startup, but the vast majority of startups and the vast majority of companies will at some point, maybe not right away, but at some point generate revenue, and everything else about the financials of the company will be based on the revenue. Obviously, the amount of money that the company will have to spend will be dependent on its revenue. The amount of money that the company can use for operating expense is going to be based on revenue. The profit of the company is going to be based on its revenue. So most financial models, including ours, are going to be fundamentally based on revenue. And that also highlights an important factor in financial modeling. Because the revenue forecast is the foundation of the financial model, we need to be as confident as possible in the revenue forecast. Meaning what? One thing I always like to tell entrepreneurs before they start on their financial model, or while they're working on their financial model, the goal of our financial model is not to make it correct. Because why? When I say not to make it correct, I mean it's not to correctly predict what's going to happen in the future. Nobody can predict what's going to happen in the future. The future is unknown and unknowable. So financial models do not predict what's going to happen to your startup in the future. And it's very important to remember that, because if you encounter a problem in your financial model and you start to see that something in your financial model doesn't match your understanding of the real world, then you have to always assume that the real world is right and your model is wrong. So if the financial model is not designed to predict what's going to happen in the future, what is it designed to do? It's designed to prove that your business model can work. So in the financial model, you create a scenario that illustrates to investors and to yourself that the business model that you have for this company can allow the company to reach the expected exit valuation in order to support your current valuation. So that's the goal of our financial model. Goal of our financial model is to show that under using an industry standard financial model, using a reasonable set of assumptions, we can arrive at an outcome where the company achieves an exit valuation sufficient to support your current valuation. And of course, both sides need to do this. The startup needs to do this to convince investors that this investment makes sense, and investors need to do this to make sure that this investment in fact does make sense for them. Okay, so it's very important that we feel confident in our revenue forecast, not confident that it's correct, but confident that it is reasonable and consistent, and that we can defend it when one or the other side challenges our assumptions. So how can we do that? When we're trying to arrive at a number or a series of numbers that we don't have any way of actually predicting, how can we come up with a series of numbers that actually make sense and are defensible? And the way that I like to do that is we use two methods of calculating the same number. So we're going to calculate our revenue forecast using both the top-down and bottom-up method. The top-down revenue forecast method is a way of forecasting the demand for the company's product. And we look from the top down, meaning we try to estimate what might be the current demand for our product, and then we can grow that demand over the forecast period. And that gives us one way of projecting our revenue. And then this is what it looks like. So to do top-down revenue forecast, we start with an estimate of the total addressable market. Then we take a percentage of that total addressable market and define it as our target market. Then we take a percentage of the target market and define it as our target segment. And then we take a percentage of the target segment and define it as our year one market share. And that will be our year one revenue. So for example, let's say our total addressable market is $1 billion. If our target market is 10% of that, that means our target market is $100 million. If our target segment is 20% of that, it means our target segment is $20 million. And if our market share in year one is 10%, that means our year one revenue is going to be $2 million. So that's the top-down method. Now, very important to select the right addressable market, the right target market and target segment market share, but that's how it works in calculation. So we start from total addressable market and get down to year one revenue forecast. So I call this a bullseye diagram. And you can see that the center of the bullseye is going to be our year one revenue forecast, top down. Bottom-up revenue forecast is a way of forecasting our year one revenue from the supply side, meaning using our business model, we estimate our ability to supply the demand that we are forecasting in the top-down method. So you can see in this, for example, in this diagram, the company has subscription revenue, licensing revenue, and online advertising revenue. So they have 3 revenue streams. And each of these revenue streams has revenue drivers. So their subscription revenue is driven by standard premium and enterprise subscriptions. Their licensing revenue is driven by license and new licenses and renewals. And then their online advertising revenue is driven by CPM and CPC. So, and then we have the detail of those revenue streams over on my far right side. When we multiply these numbers and then add them all up, we get our total revenue forecast from a bottom-up perspective in year one. And that total revenue is on the left side in the total revenue box. So if you think about what we just did, when we do top-down revenue forecast, we attempt to forecast demand. When we do bottom-up revenue forecast, we attempt to estimate our ability to supply that demand. If we have made reasonable and consistent assumptions in both methods, then our year one revenue forecast from each method should be the same, meaning the center of our bullseye diagram and our total revenue box on the left side here should be giving us the same number. And if that is not the case, then there's something inconsistent about our assumptions. Now, when we use this method, top-down and bottom-up revenue forecasting, in order to arrive at our revenue forecast, the fact that in the first, what I call first iteration, the two numbers are not the same, our year one revenue forecast from top-down and bottom-up are not the same, that's not a bug. That's a feature of this method. Because why? We can use the difference to improve our final number. And we do that through looking at the initial output from both methods, top-down and bottom-up forecast, and then anchoring on one of those numbers, meaning we're going to choose one that we think is more reasonable, and we're going to then adjust assumptions in the other method to try to bring the result from that method closer to our anchor number. And then that'll give us our second iteration. And if we're doing if we're using the method properly, our forecast will begin to converge. So we will see that our top-down and bottom-up forecast are getting closer to one another. And as we continue to do this through multiple iterations, ultimately, we will have the exact same forecast of our revenue in year one using both our top-down and bottom-up revenue forecasting method. And once we have done that, we will make assumptions about the growth rate of our revenue over the rest of the forecast period. And we will then arrive at what I would consider a very solid and defensible revenue forecast, which is going to form the basis of our valuation model. Now, when we consider the different valuation methods that we're going to use, revenue forecast is extremely important for all of them. So revenue forecast, it's going to be important for comparables because it's going to help us determine which companies are comparable. It's obviously going to be critically important for discounted cash flow because ultimately our cash flows are derived from our revenue, and it is going to be extremely important for our VC method because the exit valuation, which is going to be the output of our VC method, is going to be determined as a revenue multiple of our revenue in the exit year. So that's why we're going to spend so much time on getting a solid revenue forecast. So let's take a look at how we actually do that in our financial model. All right, I'm going to share my screen. Okay, so this is my Expara's pro forma financial model. If you have already registered in the companion online course, you've gone to the download section, you should have been able to download this same version of the model. You can follow along on my screen, or you can follow along on your own version of the model. If you're having difficulty for whatever reason downloading the model, or not able to find it, just send us a message and we'll help you to get a copy. So everybody also is free to use this model after the course. And if you have any feedback on the model, don't hesitate to let us know. So you can see the first tab that I'm on in the model. It's called top-down versus bottom-up revenue forecast. This is exactly what we've been talking about for the last few minutes in my PowerPoint slides. You can see, make it a little bigger. You can see the top section here is my top-down revenue forecast. The bottom section is my bottom-up revenue forecast. And at the bottom of this page is the difference between my top-down and bottom-up revenue forecast. So if you remember the point that I made about this in the previous discussion, we want these numbers to ultimately be the same. So the difference between my top-down and bottom-up revenue forecast ultimately should be 0. And the bottom up as a percentage of top down should be 100% because ultimately these two forecast methods should yield the exact same revenue forecast. Now you can see on the right side of the screen, you can see the revenue forecast presented as a curve. And this is a visual way of seeing do our two curves match up? And they don't. We can see clearly that our bottom-up curve has a very different shape from our top-down curve. So once we have converged our assumptions in the top-down and bottom-up revenue forecast, we're going to see the exact same shape in our curves, and we'll be able to see both mathematically and visually that these two revenue forecasts are yielding the same results. So if let's start at the top. You remember my bullseye diagram. Now you can see my total addressable market in year one is $1 billion, just like I talked about when we were looking at the pie chart. Just one quick note about the financial model. All of the input cells are in blue. So anywhere that you're required to input a number, it's going to be a blue cell. If a cell is not blue, it's not an input. So I would strongly advise that you limit your inputs in the model to the blue cells, because if you change something that's not in a blue cell, you can't guarantee that the model is going to give expected results. So, okay, I have started with a $1 billion total addressable market, and our target market which is the second ring in our bullseye diagram, is 50% of our target market. And the target segment of the target market, which we expect to target, so the segment we're targeting is 10% of the target market, which means our target segment size is $50 million in year one. And we estimate that we will acquire in year one a 1% share of our target segment. And this 1% share of our target segment will give us a year one revenue estimate of $500,000. Now, you can also see what I was talking about when I said that we're going to grow the year one revenue forecast to achieve our revenue curve. So we grow the addressable market by this row, and then we grow the target segment separately, and then we grow our market share separately. So we can have three different types of growth from year one through forecast period, and we can adjust these based on assumptions in our specific business model or financial plan. Okay, now if you go, when we go down to the second section, this is our bottom-up revenue forecast. So remember, bottom-up revenue forecast is supply side revenue forecast. So this is where we calculate based on our product offering, how many will we sell at what price and over the forecast period. Now you notice, I'm sure you noticed that these cells are not blue. So how did we input our bottom-up revenue forecast? We input the bottom-up revenue forecast on the next tab, which is called, appropriately, bottom-up revenue forecast. And what you see on this tab is that we input our bottom-up revenue forecast monthly for the first 2 years. And after the first 2 years, we will do annual input for the last 3 years. So you might wonder why we're doing monthly inputs for the first 2 years. We do this throughout the model because typically most venture investors and most venture investment rounds will have 12 to 24 month use of funds expectation, and therefore the financial results of the company in the first 2 years are going to be especially important for both the startup to explain and for the investor to understand. And by doing the bottom-up forecast monthly, we can also address things like seasonality in the sales cycle. And also later, tomorrow, 2 days from now, in the next session, we're going to be talking about our cash flow forecast. And by doing monthly projection, it helps us to avoid some errors which can creep into annual projections where we, for example, have negative cash flows in the middle of the year, but they don't show up in our annual number. So this model won't let us do that. And in fact, it will highlight if we have any negative cash flows in the first 2 years. So this section of the model is identical to the waterfall diagram that I showed for the bottom-up revenue forecast. So you can see in this case, we have the company has, instead of 3, they have 5 different revenue streams, which is a lot. Now, one thing to note is the default numbers in the model are not, don't mean anything, except in a very few specific cases where it's indicated. So don't read anything into the inputs in the model. They're basically a random set of numbers. So in this case, revenue stream 1, the product is $100 per unit. They're projecting to sell 10 units in January, and then they're forecasting no growth in number of units, but that they're going to be no growth in the price, but the 5% or 10% monthly growth in number of units. So you can see the bottom-up revenue is increasing steadily in revenue stream 1, revenue stream 2, $30 per unit and selling 20 units, and et cetera, et cetera. So bottom-up revenue forecast, and in the end, these 5 revenue streams will generate the total bottom-up revenue for the first year. So let's go back now and look at the top-down versus bottom-up revenue forecast, because we remember that the key to this method, the key to the method of using both top-down and bottom-up revenue forecast to do our ultimate revenue forecast is iteration. So we need to calculate both, and then we need to compare, and we need to see the differences, and then we're going to anchor on one, and then we're going to adjust assumptions in the other one to see if we can arrive at a convergent result. So how do we do that in practice?
Douglas, before you moved on.
Now, remember that our top-down revenue forecast for year 1 was $500,000. And if we go look at our bottom-up revenue forecast, so we can see that bottom-up revenue forecast for year 1 is $236,000. And this is a pretty big difference. So in fact, our bottom-up is almost half of our top-down. Now, what do we do with that information? now we have to decide, so, okay, at least if we have carefully chosen our assumptions up until now, and if we have done a pretty good job of choosing our inputs, I think we can make a fair assumption at this point that a reasonable forecast for our year one revenue for this company should be somewhere between $500,000 and $236,000. So our bottom up is telling us 236, and our top down is telling us 500,000. So at least based on the assumption we made so far, I think we can make a pretty good case that our year one revenue should not be less than 236,000 or more than 500,000, but somewhere in the middle. So what do we want to do next? So now we want to pick one of these numbers to anchor on, meaning which one do we think is closer to the final number that we want to use as our year one revenue forecast. All things being equal, we should usually have a preference for our bottom-up forecast versus our top-down forecast. Why? Because our bottom-up forecast is based on our product, our pricing, our knowledge of our customers, our understanding of our ability to sell our product. Top-down forecast is usually based on industry research. So because we're trying to calculate demand, and that will typically be secondary market research rather than primary market research. And it'll most likely be, if you remember how we did it, we derived it from total addressable market, took a percentage of that as our target, took a percentage as our segment. The total addressable market number almost certainly came from industry research, and it's about companies like ours, but it not specifically about our company. So we should feel like, okay, in the final number, in this case, should probably be closer to our bottom up than our top down. Because why? Because generally we feel more confident in bottom up, and also because our bottom up number is fairly reasonable. So this is a really important step in financial forecasting that I see many startups miss. I call this reality check. So reality check means we compare what our model is telling us to what we know about the real world. And when we look at real world startups, more real world startups have year one revenue closer to 250,000 than to 500,000. Because why? The first year is very difficult for startups to generate revenue. And if you think about this in a Thai startup context, this is pretty significant revenue in Thai baht. So if this was the first year of the company's operation and they're able to generate 250,000, 300,000, let's say 300,000 US, it's already 10 million baht. It's a lot of money for year one revenue for a Thai startup. And 500,000, 15 million is already starting to get pretty significant. So what do? Now we want to look at what is probably the weakest assumption in our top-down forecast. So maybe it's our market share. Maybe we're not going to capture 1%. And actually, I'm always skeptical of numbers like 1%. Because why? Because 1% sounds very arbitrary, like we just pick a number. Usually, we don't wind up with 1%. If we're going to wind up around 1%, it's probably 0.7 or 1.3. So let's say of course, we don't just change numbers randomly in real life. Now we would have to go look at 1%, is it correct? Or maybe it should be less. And how would we figure that out? We look at other companies like ours, historically, what was the market share they accomplished, they achieved in year one. So let's say it should be something closer to 0.8. So now that gives us 400,000 instead of 500,000. So maybe we're starting to get more confident in that. Let's say we did a lot of thinking about that and felt like 0.8% market share was actually quite realistic. So maybe now our bottom-up number should come up a little bit. Maybe 236 is a little bit overly pessimistic. So we can go and look at our bottom-up revenue forecast, and then maybe we say, 10 customers, how about 10 units in month 1 and 5% growth? Maybe we can, maybe that's okay, but maybe later we're going to grow faster than 10%. So what if we make this 20%? So for the rest of the year. And then let's go take a look now. Okay, came up a little bit, and maybe we want to come up a little bit more. So you can see how this is going to work. We're going to go back and forth between our top-down and bottom-up assumptions. We're going to look for what are the assumptions that we have the least confidence in, or I would say the assumptions that we think are the weakest, and then we're going to adjust to achieve a convergent result. And ultimately, our top-down and bottom-up forecast will be the same. Now, in the first year, we see not that much difference at an absolute level, and for the first couple of years, it's okay. But you can see in years 4 and 5, something is very wrong. So by year 4 and 5, our bottom-up revenue is way exceeding our top-down revenue here by 250% and here by 400%. So this is a great example of how using these two methods to do our revenue forecast can highlight significant problems in our assumption. Now, if I was only doing bottom-up revenue forecast and I was coming up with these numbers, maybe I would think that my bottom-up revenue forecast makes perfect sense. But now when I have to compare it to my top-down, I see something is very wrong. On the other hand, if I was only doing my top-down revenue forecast and I didn't have a bottom-up to compare it with, I might be totally comfortable with my top-down and not have any reason to question that it makes sense because I don't have a standard of comparison. So clearly, as we work through this model, the next thing that after we get the fix the convergences in the early years, which I think it's not going to be that difficult, but we're going to have to go look at what is driving that huge divergence when we get into the out years. Okay, so that's how we do our top-down versus bottom-up revenue forecast using our financial model. Everybody, if you haven't already got your copy of the model, please go ahead and do that. Okay, so that's my introduction of our Excel model, and hopefully now everybody has a pretty good understanding of the top-down, bottom-up revenue forecast, how you get started with that, and how you arrive at as robust of a revenue forecast as you can. I'm going to now move to answering questions. I'm going to stop sharing my screen. Okay, and I'm going to go look in the chat box. I see seems like some questions. So
okay, there is some questions regarding the model on the bottom up on row 15 and row 16.
Oh, sorry, Nan, did you say something?
There is question in the chat box. Can you hear me?
Yeah.
Okay, there is question in the chat box asking you to please explain row 16 and row 15, bottom-up forecast.
Oh, so, okay, row 16 and row 15.
Yes.
And which page was this?
The bottom-up revenue forecast.
Oh, so, okay. So I'll share that screen again. Hold on. So so the question was about row 16 and 15. So 16 is churn rate and 15 is new customers. So in the new customers mean how many new customers were added in that month, and churn rate means what percentage of customers left in that month. So when we talk about tomorrow, in the next class, when we talk about the customer lifetime value versus customer acquisition cost, these numbers are going to become very important. So number of new customers and churn rate of customers are important inputs into our customer lifetime value and customer acquisition cost calculation, but they don't impact what we talked about today. So the absolute number, so our bottom-up revenue is independent here of our total customer, new customer, and churn rate calculation. This shows us how many customers are driving our revenue and the breakdown of revenue by new customers and existing customers. So not required to get a result, but will be very useful when we try to calculate customer lifetime value versus customer acquisition cost.
There is one follow-on question on that. How does new customer become the negative number?
Oh, this means we're losing customers that month. Minus, yeah.
There are numbers of questions flowing into the Q&A. I will be asking the entrepreneurs the attendees, if they would like to be asking the question. But in the meantime, you can take a look.
There were a couple of other questions in the chat, in the chat box, which I saw at the top. Somebody, wait.
There is this question. According to bottom-up revenue forecast, if the price lag unit is changed in the year, what formula will it be in cell Z9?
Oh, okay, hold on. This is going to be, C9 is going to show you the year-end number for that year. That's going to show you the price per unit at the end of the year, December that year. Okay. So, okay. Oh, somebody asked a question in the chat. If we buy a startup, will the auditor use the same method to appraise the value of startup so that company that we acquire? So, yeah, I would be very careful about auditors' valuations of startup. Like the way that auditors value startup is the way that auditors value companies is very different from the way that venture investors value companies. So this is one of the things you have to watch out for. But of course, the actual value of the startup when you acquire it is going to be the value that was paid, not the auditor's value. Okay. Okay, so I'll move to Q&A. So in the Q&A. First question in the Q&A, what's the difference between acquisition and buyout? So in my slide that shows exits, I show both acquisition and buyout. Buyout means that the company was purchased by private equity, basically by private equity fund, not by another company. So acquisition is acquisition typically by another company in the same, usually in the same sector or adjacent sector. A buyout is a purchase of the startup by a private equity company, a private equity fund that looks to buy the startup, and then typically they try to increase the value and then sell to somebody else. So that's called a buyout. This type of exit, buyout, it's LBO or buyout by a private equity fund. It does happen in the US, which is where that data comes from, but it's not very common in Southeast Asia yet. So it might become more common, but right now I think it's not a meaningful percentage of exits in Southeast Asia venture capital. So I don't spend a lot of time on buyout in our discussions about exit strategies. It might become more important over the next 5 to 10 years, but right now it's very small. Okay, so next question. So the question was about top down and bottom up, wondering how big difference between these two numbers is allowed. So yeah, just to make clear about this, my idea is I always like to see those two numbers the same. Now, there's no rule that they have to be the same. This is just best practice, because this means that the assumptions make sense and are consistent with one another. So if you're spending a lot of time, let's say, you're doing your best to get the two numbers to come out the same, but in the end, there's some small difference between the two. It doesn't matter, because at that point, you just pick one. And actually, the model lets you pick one or the other, and if they're different. So I would do my best to get them to be the same. If they get once they get within a few percentage points of each other, if it's just too much work to get the difference to zero, I would just go with whichever one is a little higher if they're close enough to each other. Oh, okay, so next question. How can we know what percentages we should put in for assumptions? We just randomly put some percentage in. Definitely not. We definitely don't want to put random percentages in the assumption. When I do the example, I just change the numbers. But in real life, when you're working on the model, you're going to spend a lot of time coming up with the percentages. Let me put it this way. Every input that you put into the model, you need to be able to explain and defend. Because, for example, one of the benefits of using a model like this is when you start negotiating valuation with investors, then one of the big questions, it's going to be about your revenue forecast. So let's say, you input that you're going to have 200% growth in your revenue in year one, between year 1 and 2, and investors feel it's going to be 100%. And the investor has a very strong argument why their number is correct. And you just randomly pick that number, then obviously that number is going to wind up at the investor's number in negotiation, which means your valuation is going to go way down. So when you say, how do we know what percentage to put in? You won't know, because there's no right answer what number to put in. What you need to do is you want to develop a very strong argument why your numbers are correct and or reasonable. And your argument is based on your understanding of your market, your understanding of your business model, and your financial plan. So definitely don't only not put random numbers, but don't put any numbers in the model that you can't completely defend and explain, because the goal of having a model like this, the reason we're using this model for valuation is because both sides want to use this model to negotiate the valuation. And in order to negotiate valuation effectively with your model, you need to be able to explain and defend every assumption in your model. Okay, next question. What if you have already been bootstrapping for first 3 years? Which growth rate or any growth rate should we adjust? So, yeah, okay, there is a feature in the model that lets you put in the historical financial numbers. So if you have real historical financial numbers preceding the forecast period, you can put the real numbers in there. So you can use your real historical numbers from your bootstrapping phase, and you can put those into the model if you choose. I wouldn't say that necessarily would affect your growth rate, because the growth rates that we're going to put in the model are about the future. And one thing that I would advise when you're doing a model like this for raising money, typically what you want to model is you want to model what the results are going to look like after you get the money. So assuming that you're going to get the money, for example, this year, then you're going to assume that your growth rates are consistent with the money that you're raising. Meaning you're going to raise money, you're going to invest that money in growing the company, and therefore you're going to have very fast growth rates. Okay, next question says, so we always assume exit value at 100 million and work backwards. I mean, VC need to make sure that they invest as little as possible for the maximum return at 100 million. So I wouldn't exactly say that. So the reason I include let's say the 100 to 160 million as the average exit valuation in a trade sale for a US-based startup is that I would use that as a benchmark for your exit valuation. So your exit valuation can be significantly higher than that or lower than that. But at least this gives you a number to benchmark your exit valuation against. Like, instead of just, because I see a lot of startups, for example, they have exit valuation 30 million. I can guarantee you that exit valuation 30 million, if you're raising $500,000, forget it. You're never gonna be able to raise $500,000, 15 million Thai baht, and generate at any acceptable valuation for you if your exit valuation is 30 million US dollars or 1 billion baht. There's no way at early stage that can generate a reasonable return for a venture capital investor. So that's why I said we should use this empirical data as a benchmark to array our valuation around. Later we're going to calculate, we're going to learn how to calculate the exact forecasted exit valuation for our startup. So that'll be covered in a later lesson, but just keep in mind empirical data when you look at the range of possible exit valuations. So by same token, everybody shouldn't be claiming we're going to exit for $1 billion, because that, 30 billion baht, the vast majority of startups don't exit for $1 billion. We read a lot about the startups that do, because those are freakish outliers, and so they're in the news. So think about realistic exit valuation, aggressive but realistic exit valuations benchmarked against some empirical data. Okay, how could we show financial plan and revenue forecast to VC in a pitch deck? Oh, so actually the financial model that we passed out, that we provided, does give you it has several sheets where you can copy and paste into your pitch deck. So I'll point those out when we go through the financial model in the later class. where you can extract the chart. There are several charts and tables in the financial model that summarize key financial points that you can use in your investor pitch deck to summarize your financials. And actually, yeah, the model is very good at providing you with concise tables and charts that you can use in your investor materials. Oh, so next question. Are the following the same? Target market versus SAM, target segment versus SOM. So I think, I don't know if these are exactly the same. You know, there are different ways of describing our segmentation. So if you are more, if you're more comfortable with like serviceable addressable market or serviceable available market or serviceable obtainable market rather than the target market and target segment that I use, is okay. As long as you are, as long as your calculation and your model makes sense, you don't have to use exactly the same phrases that I'm using. Okay, next question. In your view, what is the best way to do the startup valuation? Wait, hold on one second. Okay, so I don't want to give away, you know, all the excitement from later class, but definitely my view is the VC method is the best way to do startup valuation. But what we're going to do in our model is we're going to do all three. We're going to do VC method. It's very similar to the approach that we're taking with the market, with the revenue forecast. We use two methods. So which is better, top down or bottom up? Actually, you know, both are good, but together they're much better. So although if I had to choose one, I would always choose VC method. But if we do VC method combined with DCF, combined with comparables method, and we get the same result from all three, then we're going to get that same confidence that we have from doing both top down and bottom up revenue forecast to get our revenue number. So the answer, if I have to pick one, I would pick VC method, which I will explain why when we go over VC method in class 3. And but ideal case, we use all three together, and all three will give us the same result. And that's how our financial model works. And I think this gives both sides the most confidence that we're getting the best answer that we can on the valuation. Oh, so next question was, can I explain more about what is the definition and difference between target market and target segment? So the what I mean there is target market is, okay, I start with total addressable market. So for example, so this is the biggest possible definable market for our product. The target market is the target we're going to focus on within that. So for example, okay, let's say we're doing plant-based meat, you know, which is a category that I like a lot. So total addressable market might be the global market for plant-based meat, but our target is Southeast Asia. So we're going to take the Southeast Asia percentage of the total plant-based meat market and make it our target market. And then what's our segment? Maybe we're going to focus on dairy segment. So the dairy segment within the target market of Southeast Asia plant-based meat. So we'll look at how much of that target market is in the dairy segment. And then the share that we'll acquire that would be our market share in year one. So that's how I define those different terms and how they fit together. So next question was how to download the Excel file. So if you have already accessed the online course, the easiest way to download the Excel is to go to the companion course, and in one of the first lessons in the companion course is called course downloads. And within course downloads, you're going to see the Excel file. You just click on it and download it. So most startups are optimistic how to do a good forecast. That's okay. I believe that we should be, like one thing that I always advise entrepreneurs, a lot of entrepreneurs tell me, we're going to do realistic forecast. I don't think we should do realistic forecast because, or pessimistic forecast. Realistic forecast in startup should be what? I think realistic forecast in startup should be 0. That's the most realistic outcome, or 100 million or more. So realistic forecast for my startup is very binary. So what I think we should do for the startup, it's okay to be optimistic. I call we should be aggressive but reasonable. So meaning what? Meaning that we do an aggressive case, but it has to be within reason, meaning internally and externally consistent. So it's not a fantasy. It's not like a dream. It's something that if we are able to accomplish everything that we set out to do, we will achieve. And we know that it is possible for startups to reach, for example, valuations like 100, 200 million US dollars within 5 to 10 years, and sometimes even more. So we know that's achievable. And I think if we define that as optimistic, that's fine. And when we go back to good forecast, remember, the goal of financial forecasting is not to be correct. All financial forecasts are incorrect. And if you want to learn more about that, I have both a video and an article on the companion course where I talk about that in a lot of detail. So I don't define good forecast as a forecast that 5 years from now we could check and see if it was what actually happened. A good forecast is one that gets us this round of investment and ultimately leads to both investor and entrepreneurs making a lot of money. Okay, in the pitch deck, so next question. In the pitch deck to investors, should we represent the market for the first year or the next 3 to 5 years? So I usually prefer to focus on the market size analysis for the first year, because this is typically what investors are thinking about, especially at early stage investment. We will show revenue forecast over the 5 years. So that will be related to the market size. So I think the key thing about the future market size is, does it support our revenue assumption? So as long as our future market assumptions support our revenue assumption, showing the revenue in the forecast should be enough. So there's another question about the range for difference between top-down and bottom-up revenue. Again, don't worry too much about that. Use your judgment. When you think they're close enough, then just pick one, and I would probably pick the higher one. If you can get them to come out exactly the same, that's the ideal case. So, okay, next question was, if the VC is using a SAFE, what are the key things that entrepreneurs need to consider? So this is a very good question, but it's a little outside the scope of our discussion tonight, because there's a lot of things to consider about SAFE. And in fact, normally SAFE doesn't have a valuation. Normally SAFEs are discounted versus a next round valuation. They might have valuation caps. In section 4, I am going to talk about the difference between valuation caps and valuations, like valuation caps, like what we see in SAFEs, versus equity valuation, like what we're learning to calculate in our class. If you're really interested to find out more about the differences between SAFEs and equity investment and convertible notes, and what we need to consider, I do have some articles about that. So just send me email or message. Just so everybody knows, there's communication platform within the online course. So you can message me inside the online course with any questions that I don't get to here, or any questions you come up with. And something like this that's a little off our topic, I'm happy to answer in outside of the class Q&A. So in the VC method, do we need to consider profit? Meaning the startup only need to grow sale and no need to think about profit. So this is a good question. In the VC method, the key input is going to be the exit valuation. And this is where profit may or may not be important. So if your company, when we calculate the exit valuation, which again, we're going to cover how to do that in a later class, but if the exit valuation is dependent on profit, then profit will be really important. So meaning if you're doing a listing, probably your IPO, your profit is probably going to be very important input into VC method because the value of your company at the listing will probably be dependent on your profit. If you're going to be purchased in the M&A by a company by companies that typically buy on revenue multiples, then profit will be less important. If you're going to be in a market where there's a mix of those two, then profit will be important. Okay. And a question from my good friend and original Expara team member, Nikki, not news. So sometimes startups raise funds through convertible debt and deferred valuation in another round. When should the startup have the valuation? How many rounds of valuation could be deferred? So typically, so that's a really good question. When startups raise money through convertible notes or through safe notes, there's typically no valuation set, and the valuation at which those instruments convert will depend typically on the next round valuation, because most convertible debt and safe notes convert at a discount to the next round. So it's very rare that they would convert at a discount beyond the next round, except in the case where what's called a defined financing or a specific threshold for funds raised is a trigger for conversion. So it could be, for example, convertible note might say qualified financing means the company raises $1 million. If they raise 800,000 in the next round, then the note may not convert at that round, and then it would potentially convert at the subsequent round after that round. So one of the great things about convertible notes and safes, though, is that we don't have to calculate valuation. Now, again, because they're not priced, that's a difference between these notes and equity rounds. Again, I'm going to talk about the difference between valuation caps that we do see in convertible notes and safes and valuation in a later lesson. Okay, next question. To make the bottom-up forecast and growth, does a startup need to consider its capacity? Yeah, definitely yes. So bottom-up forecast should be based on what the startup believes they're going to be able to achieve over the forecast period. And that's why I said when discussing this that we feel typically more confident in our bottom-up forecast than top-down, because bottom-up forecast is derived from the startup's estimate of their capacity. So what are the pros and cons of top-down and bottom-up method? So I think I talked about that already a little bit, but the pro is that the top-down method gives us an estimate of demand, which we don't get from the bottom-up. And bottom-up method is based on our company versus top-down, which is based on industry or secondary market data. So I would say both have their plus and minus, but that's why together they're much stronger than either one individually. So let's assume we have reasonable results, both top-down and bottom-up. Can we say that if top-down is greater than bottom-up, there's room for business to grow? But what should the result of bottom-up greater than top-down be interpreted? So I would say if top-down is greater than bottom-up, it means that the startup is not servicing all available demand. So then I would look at why is that happening? Because this means if you think about the last calculation in the top-down is our market share. So this is the market share that we estimate that we can acquire, but yet our bottom-up is telling us that we can't service the demand from our market share. So something is off there. right? Either we're estimating that we're going to capture too much share, or we're estimating that we're going to produce too little for the share that we believe that we can acquire. And if the bottom up is greater than top down, then how I would interpret that is that we are projecting that we're going to produce more product than there is demand for, which means that we're going to have a lot of we could have unsold product, like our supply exceeds available demand. So that's how I would interpret bottom up is greater than top down. So if you think about those, that's why ideally the two should be the same. Should we include revenue from non-core business in the model, or keep it only revenue from core business? So I think this depends on what's the company's plan. If we have multiple revenue streams and we plan to develop each of those revenue streams, then we should include in the model. Typically the model should reflect all the revenue that the company is going to generate. So assuming that all of the revenue is accruing to the company that the investor is putting their money in. So I would say if the company's strategy is to maintain that non-core revenue, then I would definitely include that in the model. And then next question. For a startup that already generated positive earning and positive cash flow, with DCF okay to use for valuation? Also, if DCF is being used for valuation, the company decide to use the right offering to raise additional funds. This way, the company will receive additional cash, unlike stock selling. This will increase company value. Do we need to change the capital structure for this too, as more cash coming in the company? So we're going to go over, this is a really good question, but we're going to be going over DCF valuation in a lot of detail in the next class. So I think we'll defer that question for discussion in lesson 2 when we go over DCF valuation in detail. Okay, so I think that's all the questions that I see in the Q&A section. I believe we have reached the end of our scheduled time for session 1. So thanks for these great questions. I'm really glad we took up the whole question and answer session.